Markets on alert. Inflation data is on the radar. Welcome to Market Insight. I'm David Pollard. US Treasury 10-year yields topped 4% for the first time in more than 2 months this week, while a widely watched part of the yield curve briefly inverted as markets reduced bets of another supersized rate cut following Friday's strong US jobs report. This in a week where markets and the Fed are bracing for the latest inflation readings, September CPI on Thursday, followed by PPI the next day. Well, I'm joined now by Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. Welcome, Matt. To what extent should a strong jobs report and indeed other strong data be putting inflation back on the radar as an area of concern for investors like you?
It is a bit hotter. The economic data is coming in stronger from the services ISM to the jobs report. But we'll have to see in this inflation report. The housing market is the key to the inflationary trends in the United States. It rose 0.5% month over month in the last CPI report. We think that's going to come down a bit in this CPI report. The estimates are for 0.2% month over month. That shouldn't be too bad, but it could be that we're seeing strong economic growth with modest inflation. We get that. That's actually a pretty good backdrop.
So what of the Fed? A series of Fed officials have been pledging their allegiance to easier monetary policy this week, and yet markets have been edging up their bets on no cut at the November meeting, with a massive majority seeing just 25 basis points. Where do you stand on that?
Yeah, the bond market had gone a little too far too fast in pricing in cuts. A couple of weeks ago, we were looking at 50 basis point rate cuts really for November and even potentially December from the bond market. And the Fed at the summary of economic projections said we're only doing 25 basis points likely in November and December for 4 cuts in total of 25 basis points for the end of the year. They already did 50. So the bond market, in our view, is actually listening to the Fed saying, hey, we're not that dovish. We're dovish. We're just not that dovish. So we think that's why yields have come up a little bit here and oil prices have risen. You've had some other, confluence of events that have probably caused rates to rise a bit. But we think it's going to calm down and we could actually see lower yields into the end of the year.
Well, to extend that thought or that question, yields, as we mentioned, were above 4% for the 2- and 10-year Treasuries on Monday, with in fact the curve inverting for a while. What do you make of all that, and is it a good time to load up on Treasuries?
So oil prices spiking is an inflation impulse that really comes in full force immediately into the Treasury market. And we think that's really what the geopolitical risk out of the Middle East caused oil prices to rise. That likely caused Treasuries to rise, or Treasury yields to rise. The other thing it's a more nuanced, it's hard to pick up on, but there may be some election elements to this. So former President Trump's odds as it relates to the election have gone up a little bit. That has typically been with higher Treasury yields. The market's expecting greater deficit spending under his potential time in the White House. And so Treasury yields often rise when he gets more odds of winning the election. All these things to us, though, are transitory. They're things that are potentially not very firm fundamental catalysts. And as a result, we actually think Treasuries offer value here after the recent backup in yields.
Well, you mentioned deficit spending there, and a report today says Donald Trump's tax and spending plans would produce around $7.5 trillion of new debt over 10 years. In other words, around twice as much as that of a Harris administration. That's according to the Committee for a Responsible Federal Budget think tank. So how does John Hancock view such a prospect, and how does it take action?
We've seen time and time again the period into the election is full of uncertainty. The NFIB Small Business Optimism survey this week actually said record uncertainty of small business owners in the United States. There's a lot of things that are thrown around in terms of potential policy. At the end of the day, you have Congress, which can often limit what policy gets done. We wouldn't overplay it. And really, we want to go back to the fundamentals. What we're seeing is a disinflationary environment, inflation slowing. Growth is actually strong, but we could see weaker growth in the next year, still modest growth. In our view, that means Treasury yields still have downside. So there's a lot of noise out there as it relates to politics. We would not use that as an input into portfolios. And if anything, you see volatility near term or as it relates to it, we would look at it opportunistically. High quality bonds, we think, are an opportunity here today.
Q3 earnings, the other big focus, of course, with the first big US banks coming up on Friday. And a weaker picture seen as likely from JP Morgan, Wells Fargo and some others. What are you expecting?
So out of the financial sector in the S&P 500, the analyst estimates are for basically no growth. We think that's actually a pretty nice low bar here. If you look at stocks and bonds, global equities and bonds, they're up massively over the last year. So 30% on the S&P 500, 11% on the U.S. aggregate index. That should create some higher asset management fees. The yield curve is steeper and the dollar's weaker. All these things usually add up to better earnings results. The bar is nice and low. The thing is that from here, analyst estimates are for double-digit, amazing earnings growth in Q4 and all of 2025. We actually think they could be a little bit better in Q3, but probably not as good as the street is looking for as we go forward into 2025.
And looking at the earnings season overall, where, if any, do you see surprises coming from, both negative and positive?
I think financials this quarter could actually do a bit better than the street's looking for. The only thing is the prices have already reflected that. Financials have done really well this year. Healthcare is a place we would look at as actually some cheaper stocks. The valuations are nice and attractive. They haven't kind of priced in some great earnings. And if they can beat or even kind of come in line, we actually think that could be a sector that could do well as it relates to this earnings season. High quality stocks, defensive in nature. And they also could do in 2025, they're expected to see a nice earnings recovery that could be brought forward into the final quarters here of 2024.
Okay, Matt Miskin of John Hancock Investment Management, many thanks for sharing those thoughts with us today. That is your market insight. You can watch more videos on Reuters.com.